This is Larry Williams, a professional trader who turned $10,000 into $1.1 million in just 12 months of trading, which is a profit of 11,300%. Now, if you're anything like me, you're probably thinking, how on earth did he do it?
Can you tell us anything about that, Mr. Cole?
So, what can I do to find out? Well, I decided to reverse engineer Larry's Trading World Championship winning strategy. What's more, after many hours spent reading, researching and testing to unearth the exact strategy Larry used to make his gains, I'm going to provide the full strategy for you. And believe me, I discovered some killer stuff here, including a goldmine of trading tips I found and summarised from reading Larry's books. It's worth noting here that Larry Williams has developed numerous trading strategies, but we're just covering the one that he used to win the World Cup Championship of Futures Trading. So stick around to the end to find out how to make bank yourself. I've got to say, Larry is a total boss for coming up with this strategy, because my word, does it work amazingly. Okay, let's get to it.
We're going deep and we're going hard.
The strategy Larry used to make these huge gains is called the LW Volatility Breakout Strategy. LW for Larry Williams. Sounds sensible. So this specific strategy is based around one primary indicator, which is the Donchian Channel Indicator. To add it to your chart, go to the Indicators tab in TradingView and type in Donchian Channels. Click this one right here. The second indicator used is the Larry Williams Large Trade Index. To add this to your chart, go to the Indicators and type in Larry and select this one by LOXX and add it to your chart. The third and final indicator is the Volume Moving Average. Go to Indicators, type in Volume Moving Averages and select the one by Warrior 504TH and add that to your chart. Now, for the Larry Williams strategy, we're using the 5-minute time frame only, as that's what his trading results are from. By all means, use a higher time frame like the 1 hour or 4 hour for marking out levels, but all trades are taken based on the 5-minute time frame. Donchian channels are similar to the mighty Bollinger Bands, and they're an excellent indicator. But to align with Larry's strategy, we need to change the settings. So let's go to the settings and change the length to 96, which, as you can see, I've already changed. I personally like the default colours, but you can change them if you want. Now, the Donchian Channel Indicator has 3 lines, with the middle one acting as a mean reversion for the market, and it also acts like a price magnet and gives strong signals to momentum in the market. If price is above the line, we're bullish; below it, we're bearish. The outer bands act as support and resistance and also provide breakout signals. If price breaks out of the upper band, in many cases it will continue upwards. The same for breaking downwards, as you can see here on this example. One of Larry Williams' mantras is momentum is one of the 5 concepts that can bring us short-term trading profits. It is what Newton was talking about when he said an object once set in motion tends to stay in motion. So it is with stocks, commodities and forex. Once price starts to move, it will most likely keep going that direction. This ties in well with Larry's volatility breakout strategy that we are learning here. This part of the strategy alone isn't perfect though, but Larry's thought of that. It works best by far in trending or volatile market conditions, but not so good in flat ranges. You can see here the Donchian channels are quite tight together in a flat market, meaning when they are broken there is often no momentum to the move. This can sometimes result in false signals. So the next step is to ensure we are only entering into trades that have good momentum behind them. And to do that, we're going to use our other 2 signal confirmation indicators. Firstly, let's enable the Large Trade Index, which should already be on your chart. And secondly, we will enable the Volume Moving Average. For the Larry Williams Large Trade Index, we're going to set the period to 30 and the smoothing period to 5. For the Volume Moving Average, we're going to leave the defaults of 20 and 100. This strategy uses a 1.5 to 1 risk-reward ratio as the default. You would enter a long position using this strategy when the price breaks above the upper band of the Donchian channel, as it has here. The Larry Williams Trade Index indicator is green, and the blue volume average line has crossed above the slower orange volume moving average line. This is how you would enter a long trade in this scenario using this strategy. Let's let this scenario play out and see how the trade went. Beautiful. A winner. For entering a short position, we would look for when the price breaks below the lower band of the Donchian channel, as it has here. The Larry Williams Trade Index indicator to be red, and the volume to be crossed above the volume moving average line. So the fast volume above the slower volume average line. So blue above orange. This is how we would place a short trade. So we set our risk reward to 1.5. Stop loss is above the orange line, the central line of the Donchian channel indicator. Let's see how the trade plays out. Perfect. Winner. That's not the case for every trade though. If the middle and upper band have a huge gap, you'd end up with a massive stop and a crazy take profit target. So in this case, you'd set your stop at a recent swing low like this one. There is one major secret element to this strategy that will massively improve on it. That brings us to support and resistance levels, which add a major element of uncertainty to any strategy. So if we look at this example trade here, we can see that it's actually a loser.
What a loser!
The signals looked good. We had a breakout from the top Donchian channel. The LWTI was given as a green signal, and there was indeed a crossover of the volume moving average. But if we then zoom out onto a bigger time frame, we can actually see that this is quite a large resistance level. So what we need to really do is at the start of the trading day, go to a higher time frame. I traditionally use the 1 hour to get an overview, and sometimes the 4 hour, of the prevailing trend, and draw lines for the main areas of support and resistance that are likely to get hit considering where price is at. The rule is don't take any signals or trades when approaching these levels. Wait for either rejection or breakout or breakdown with retests and new highs or lows to consider a trade. A successful breakout or breakdown can fire off all the signals for this strategy, and from my testing can be a great entry if all the signals line up nicely. Last but not least, some golden information from Larry Williams to apply to your trading and make bank. Larry says in his book, I place my trade knowing only one of 3 types of days will develop. A small range day that will produce a small loss or gain, a day that reverses against my position, or a large range day that, if I'm on the correct side, means I will finish the day very near the high of an up day or the low of a down day. What this all means to short-term traders is that to catch a winning trade, the most profitable strategy is to hold to the close. So basically, don't close trades early. Let them run all day. Step away from the screen if necessary, as the shorter the holding period, the less opportunity for profits. Larry says never forget that rule. Williams identifies and trades based on recognisable patterns such as head and shoulders, double tops and bottoms, and triangles. These patterns help predict potential price movements and trend reversals. On top of this, they can also confirm confirmations from this strategy. For example, when Larry Williams observes a bullish chart pattern like a double bottom forming on a commodity chart, he interprets it as a potential reversal signal. He might then enter a long position, anticipating an upward movement, while setting a stop loss to mitigate risk. Larry also uses the Commitment of Traders (COT) report. The COT report provides a breakdown of the positions held by different types of traders in the futures markets. Williams utilises this report to gauge market sentiment and identify potential trading opportunities. He uses it as a contrarian indicator, so if a majority of traders are bullish, Larry may look for bearish signals and vice versa. You can use this in your own trading. Don't necessarily be one of the herd. Very often the market makers do exactly the opposite of what retail thinks they're going to do. Anyway, thanks for watching, and if you learned from this video, please do me a favour and like, comment and subscribe, as I have some ballistic trader strategy videos I'm working on as we speak. Until the next time, keep chasing the edge.